This week on Wealth Track, the legacy of legendary global investment pioneer Sir John Templeton is alive and thriving thanks to the talent of his protege, great investor Mark Holowesko. Olympic sailor, triathlete, and successful money manager, Holowesko is finding exceptional value all over the world. A Wealth Track exclusive with Mark Holowesko is next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. We have a unique treat for you this week, a television exclusive with a great investor, Mark Holowesko. Well, does the name sound familiar? It might, because way back in 1987, before the famous market crash, legendary global value investor Sir John Templeton picked the then 27-year-old Holowesko to run the Templeton funds for him, a job he performed successfully for 13 years. In 1992, he was the youngest person on Fortune magazine's list of the best money managers of his generation. Now, in 2000, he got off the non-stop travel treadmill required to run the Templeton funds and launched Templeton Capital Advisors to serve institutional and high net worth clients. That firm has been renamed Holowesko Partners, which Mark continues to run out of his native Bahamas. The super competitive Holowesko is an avid athlete, cyclist, swimmer, and Olympic sailor who is cited by Businessweek magazine as one of the world's fittest CEOs. As you will see in a moment, Holowesko has absorbed many of the attitudes, disciplines, and lessons of his famous mentor with a few tweaks. One lesson he has embraced completely is to keep an open mind and constantly look at the opportunities the market is offering. Right now, Holowesko believes the opportunities for investors are fantastic. You heard me correctly. He is finding values he hasn't seen since the depths of the market lows in 2008 and 2009. We'll find out where in just a moment. I began the interview by asking Mark about the major investment lessons he learned working with Sir John.
It was a very simplistic thing. He walked into my office, he put the funds on my desk, and he said, look, from now on I want you to manage these funds, but write the buy and sell tickets and leave them on my desk so I can see what you're doing, and I'll sign them and leave them at the trading floor. And that was at about 11 o'clock in the morning. And at about 11:15 I left to go for an early lunch and a very long run, because it was, it was a bit of a shock and a huge responsibility, but a lot of fun.
So how did you feel at 27 running, it was Templeton Growth, World, and Foreign Funds, right?
And the Templeton Smaller Companies Fund. So they're all the mutual funds that Templeton had at that point in time were all managed in the Bahamas by Sir John until May of '87, and I managed all the funds. I had a lot of help in Fort Lauderdale. We had a great staff of analysts in Fort Lauderdale. And I was probably a little too young at 27 to truly understand, what was happening and to appreciate the fact that I was taking over the management from such a legend. But there was so much to do, and there was so much going on in the world. And we had the crash a couple months later, and he was there during the crash, which was a big help and a big comfort. And it was also one of the most excited I'd ever seen him, which was really interesting.
So tell me about that, because was that one of the points of maximum pessimism that he just
right.
loved?
Most definitely. He went on a number of programs right after that crash, basically coming out saying this was a great opportunity. It was a very technical, decline, and I think that was shown by some of the studies later on. And stock prices were 30% cheaper than they were, several days before that, or 2 days before that. So from his perspective, it was just a great opportunity to take advantage of the fear in the market and look for ideas. And we had cash in the fund, so we were lucky enough at that point in time. I don't remember the exact amount of cash in the fund, but we had cash we could put to work So that was very helpful.
So, you just said that you had to put for what period of time that of course, that was in the days when you wrote out order tickets.
That's right.
So you had to put, the stack on Sir John's desk, and he would go through them?
Well, there wasn't really a stack because we only had about a 20% turnover in our portfolios. One of the things that was just a big shock and a surprise when I came to Sir John was he had these positions that had 100% returns or 1,000% returns in the case of Telefonica Mexico, because they'd been there for so long, and obviously he was right as well. So it wasn't daily trading activity in the funds, because that really wasn't our style, but for the first 6 months that I put the ideas on his desk, he never changed a trade ticket. And then I think about 8 or 9 months later, he said, just pass them on to the trading room. And he could see the trades going through because we had some automation by that time, not a lot. So he oversaw it, and he was there, and he was helpful in terms of ideas and bouncing things off of. And when I saw his enthusiasm in '87 during the crash, that helped give me some confidence to do things, and that was a big help.
So what are the major investment lessons that you learned working for and with Sir John?
I think the first lesson I learned was to try to understand it and really put into mathematical terms what problems were. So one of my first jobs was try to determine the financial impact of the Bhopal disaster on Union Carbide. And what he wanted me to do was to basically quantify it, which is a very difficult thing to do, which is sort of like trying to quantify the BP disaster in the Gulf. So I would say that trying to understand problems and trying to see whether or not those problems were properly reflected in stock prices. In order to be a contrarian, you have to do what other people aren't doing. But he just didn't, he wasn't a contrarian for contrarian's sake. He tried to understand the issue and why people weren't doing certain things and whether or not he felt, the markets more than took that into consideration in terms of the valuation.
So if, for instance, a lot of it then, or was an event-driven type of analysis, if there was an event that impacted the price of a stock,
right,
then you at Templeton would be activated to look into whether or not this was an opportunity?
Right. A lot of our ideas, I would say a third to half of all of our ideas came that way. So for example, in '98 during the Asian crisis, that was an opportunity. That was an event that occurred that pushed stock prices down quite substantially. And back then you could buy cash at a discount. And there wasn't necessarily a catalyst to turn around the problem or the stock price relative to the problem. But the catalyst drove, the problem drove stock prices down, and we tried to react to that as much as we could. So
aside from events, what are the other things that would make you look at companies to decide whether or not you're interested in them?
Well, a number of things. One of the things that we always try to do is try to understand what we were paying per unit of whatever the company did. So if it was a timber company, what was the value in the marketplace, or the enterprise value, which is the market cap plus the debt of the company, net debt, per acre of timberland. That's a lot more interesting to us than to look at the book value of the company or the earnings stream of the company. So trying to figure out, what are you paying for this company per unit of whatever it does? And then it gives you a much better sense of, is that reasonable? If it's an asset management company, what are you paying per dollar of assets managed? If it's a soda manufacturer, what are you paying per can of soda they sell? And he had me do a lot of that work when I first came on board, just to basically understand, first of all, what it means to buy a company, not just the market value of the company, but what you're assuming in terms of the liabilities on the balance sheet.
So let me take you one step back from that, is that how do you decide to look at a particular company to begin with, aside from a disaster? I mean, do you have with Sir John and for you now at Hallowesco Partners, do you just have a list of companies that you monitor on a regular basis, or?
No, not really. We do a number of screens. Mm-hmm. It's easy to find problems, by the way, so problems are very prevalent all over the world, so they're pushing stocks, around dramatically. So stocks that come up into our screening because of problems are, mm-hmm, plentiful. But we do a number of screens on valuation criteria that we've used historically, whether it's private market values, and they're normally associated with a theme. So for example, we think merger and acquisition activity will pick up quite substantially right now, or over the next 6 to 12 months. And as a result of that, we'll do a lot of screening for companies that we think might be attractive candidates in that regard.
And the reason you think that M&A activity is going to pick up in the next several months is why?
Simply because there's too much capacity in the system today, too much physical capacity. Capacity utilization is lower than normal. So companies don't need to build capacity. And the cost of borrowing money relative to the return on assets that you can get if you actually go out and buy a company, that spread is very wide. So mathematically, it makes a lot of sense for companies to go out and buy assets rather than to build assets.
So it's interesting because there's been a great deal of talk about the fact that companies are sitting on these hoards of cash,
Right.
and that in fact they aren't putting this cash to use. So is there going to be some sort of a global catalyst that's going to make companies suddenly start to
Sure.
spend the cash and actually make acquisitions? Or
Yeah, I mean, there are a number of catalysts I think will occur. First of all, the cash is building up to such an extent that at some point the firms will become targets themselves. Most pharmaceutical companies that we look at today, over the next 5 years, will generate anywhere between 80 to 100% of their market value in cash.
wow.
And so obviously, 5 years from now, you're not going to be able to buy Merck or Pfizer or Sanofi at net cash. Get cash and then a business for free, in effect. And that won't stay like that.
Right.
And I think it's either going to be acquisitions. They'll make acquisitions. They'll make huge stock repurchases. They'll increase dividends. Now, as cash builds on a balance sheet, there's only so many things you can do with it. You can let it build, and already for a lot of firms, it's 15 to 25% of their market cap. You can buy back stock, and that's very supportive for stock prices. You can increase the dividend. You can get involved in mergers and acquisitions, or you can increase your capital expenditures. And because there's too much capacity basically in the world, the capital expenditure part of that equation is not going to really happen.
So in your experience, is this a very unusual situation where you have, corporate balance sheets are in such great shape and are so
Right.
liquid?
I think there's a couple things that are very unique about this period. Not only are stocks extremely cheap relative to history and relative to other assets, but the best quality companies are at a discount to the market as well. So, typically you have to pay up for quality. And today you don't. I mean, quality is being given away in many respects. So I think people really underestimate how cheap securities are today. I think they're as cheap as stocks were back in the early 1980s. And I think that in addition to that, the financial position of these companies is fantastic. I mean, most of our holdings in the United States, for example, can pay off all of their net debt with 20% of 1 year's cash flow. Those that don't have, a lot of them already have net cash on their balance sheet. And the United States is generating about 6 or 7% in free cash flow every year relative to the market value of stocks, which is a huge amount as well. So there's an enormous amount of free cash flow being built up on these balance sheets. And so the companies are as cheap as they were in the 80s, but much better quality balance sheets.
So when I looked at a recent report from Holoweska Partners, I know that I think you had 19 stocks that were 46% of your portfolio holdings. Is that a concentration that is something that you learned from Sir John? Is that a concentration that is typical of the way that you run money as well?
Yeah, I mean, we're somewhat mindful of, I guess, Warren Buffett's famous phrase that, diversification is protection against ignorance. So at some point you can be too diversified in terms of what you're doing. And we don't turn over our portfolios a lot, and we like a position, we tend to build 2 to 3% position in it. So we tend to own about 70 names in the portfolio.
And the average holding period, I mean, what kind of turnover do you have, and has it changed since Sir John's time?
Yeah, not really. It hasn't changed that much. The first name we bought 11 years ago, we still own today.
Which is what?
Yuyun, which is a shoe manufacturer in Hong Kong. And we have about a 20 to 30% turnover in our portfolio generally in the course of a year.
Some other lessons that you learned from Sir John that you're applying at Holoweska Partners as well. Are there any other major ones that come to mind?
Well, I think one of the things that most people don't realize is that Sir John was a big fan of basically changing your investment approach all the time. We maintained a list of stock selection methods at Templeton, and as the director of research, I was sort of responsible for monitoring that. And he always wanted to have 12 new ways of looking at stocks. And most people think that there's a Templeton,
formula. There have been books written about it. Right.
And to a certain extent, there is a bit of a formula. And when you're selling an institutional product, you have to have some consistency in your products all over the world. And we used to do a lot of work relative to future earnings and trying to discount future earnings to today's stock price and looking at dividend streams over that time period. But basically, Sir John said, if you're doing the same thing you did 10 years ago, it's not going to work. And so I would say we're constantly trying to improve on what we do. And I also would say that the market's always offering you something. And I think this is something that Sir John was very good at. Sir John's genius is in his simplicity, really. And he was always very good at identifying what was cheap in the market. So at some point in time, growth stocks might be cheap. Other times, value stocks might be cheap. Today, what's cheap in the market is free cash flow. Free cash flow is abnormally high. What he tried to teach us was find what's cheap in the market. What is the market offering you? And then try to understand, well, why is it cheap? What is the rationale behind those prices being so low? So flexibility in the investment approach was very important. And changing your investment approach to sort of accommodate with what the market is offering you was very important as well. So I think those sound very simplistic, but once again, that was part of his great genius.
Are there any general rules of investing that kind of are the Templeton way or have become the Holowesko way?
Well, for a long time, Templeton liked to try to find a normalized earnings number over a full business cycle. So so many people concentrate on the next quarter or what the company will do this year, that he felt that the more efficient part of the market was farther out because people weren't willing to look that far out or they weren't comfortable holding securities for that long. So he felt that the shorter term was much more efficient than the longer term. So therefore we should concentrate on the longer term. And for him, he felt that a normal business cycle was 5 years. And so we could figure out what a company could earn on a normal basis, both assuming a recession and a contraction over that 5-year time period, and discount that back to today's stock price. That was I think that is a popular formula that a lot of people hear about in terms of what we used to do at Templeton. But look, we used to do things, Consuelo, I used to go home sometimes and tell my wife, you wouldn't believe what we did today. It was so simple. And stocks that were ranked 1-1 by Merrill Lynch or 1-1 by Value Line, with the theory that Merrill Lynch was the biggest retail broker in the world back in the 80s, and Value Line was the biggest institutional seller of ideas. And if stocks were most highly ranked on both systems, they were going to get a lot of attention, and we'd narrow the list down on that basis, then we'd go out and work on those stocks. And it was incredibly simplistic, and it was a lot of fun. And sometimes, you'd scratch your head and go home and think, boy, I just can't believe I got a master's degree in finance, and this is what I'm doing here. But it was great fun, and it worked.
I know that one of the things that you told me is that you expect to be wrong a third of the time. I actually think
I hope to be wrong a third of the time.
You hope to be wrong only a third of the time, because I seem to remember Sir John had a higher number that he'd expected to be wrong.
Right.
But at any rate, so therefore, your number one job is to manage risk.
By far, that's true. I mean, I want to know how much money I can lose in every single stock I'm invested in all over the world, as much or more so, particularly in this sort of environment, than how much money I can make. So I maintain in my portfolio not only a target on the buy names in terms of the upside, but a risk number. If we're wrong, and a third of the time we're wrong, how much money can I lose? And we challenge our analysts all the time about those numbers, and a third of the time we're wrong on those numbers as well. And we think the stock price bottom might be 10 if we're wrong, and it goes to 8. And then we have to sit around the table and talk about why we were wrong, and is this very temporary in terms of where the stock price is?
So that's not an automatic sell decision.
Absolutely not.
Right.
No. I think the most important thing when you're wrong is to try to understand why you're wrong, and then to try to determine whether or not you're okay with that. That the longer term thesis for owning the stock is still in place. If a stock goes down, you don't understand why it's gone down, and you don't understand why you've been wrong, then I think it's really silly to maintain that position.
Is the market offering you up, opportunities that Sir John would be saying, look at this?
Well, we are 104% invested, and we don't often become 104% invested on the long side of our typical product, just because, and we have more ideas than cash at the moment.
And when was the last time that happened?
5 or 6 years ago, I'd say.
And again, when I looked at the portfolio, the most recent one that I was able to see, there were a lot of global names there.
Right.
Like the Johnson & Johnson and Kimberly-Clark, and
right.
As I mentioned, HSBC and US Bancorp, and I mean there were a number of companies. So what do they all have in common? I mean, what is it that they represent?
Well, you mentioned that stock list of 19 names that you
Right.
saw, and I'll give you an idea of what they have in common. First of all, they have phenomenal balance sheets. Most of those companies, once again, have net cash in the balance sheets. And as a collection, those 19 names on average can get rid of their debt with 20% of 1 year's cash flow. They yield 3.6% on average, which is 160 basis points higher than the 10-year Treasury. And to give you a sense of how cheap that is, if you just assume that those 19 names grew their dividends by the same rate over the next 10 years as they did over the last 10 years, and then you said, okay, well, how much would those stocks have to fall in order for me to get the same return on the 10-year, on those 19 stocks as the 10-year Treasury? Those stocks would have to fall 40%, because the 10-year Treasury yields 2%, and these stocks yield 3.6%, and some of them, like Johnson & Johnson that you mentioned, have been growing their dividends for the last 20 years at almost 14%. So as a collection, these stocks offer much better yield than you're going to find anywhere else in the world. These businesses are doing much better than most people anticipated, because a large portion of their business is actually outside the United States. So although the U.S. economy is only growing 2 to 3% at the most, these businesses are growing their revenues 6 and 7%, and they're growing their earnings higher than that. And they're doing that because a good bulk of their business is overseas, and the overseas markets are growing much faster. And I'd say that it's very easy to find companies that have grown the dividends consistently for 20 years, that are selling at 9 or 10 times earnings, with 7 or 8% free cash flow yields, with net cash on their balance sheets, that have the ability to grow their business the same way they've done. And in many cases, even if you looked at the past 10 years, which is a very difficult period, we've had two of the worst recessions in history, and a lot of these firms have done incredibly well over that time period. So it's not inappropriate to think they'll do equally as well over the next 10 years. So I just think people are spending so much time thinking about overall risk, about sovereign risk as opposed to company-specific risk, and they're making these asset allocation decisions that's a risk-on, risk-off trade that totally ignores company-specific valuations. And it's providing opportunities, in my view, that are consistent with the early 1980s.
We ask each of our guests if there's one investment that we all should own some of in a long-term diversified portfolio, what would it be? So what would it be?
Well, I'll say generally it's common stocks. Most people are afraid of common stocks. And I would say specifically here in America, I really think people are going to be surprised at the amount of income that companies produce. And I would say people should concentrate on, there are only 4 companies in America that have a AAA rating. I think they're Exxon, Johnson & Johnson, Microsoft, and ADP. And of those 4 names, there's only 4 of them. And of those 4 names, 3 of them are on what's called the Dividend Aristocrat list, companies that have grown their dividends for 20 years.
So Exxon, Johnson & Johnson, and ADP.
Those companies have, not only do they have AAA ratings, but they've also grown their dividends for 20 years consistently every year. And of those names, 2 of them we own, Johnson & Johnson and Exxon. So I would say people should look at stocks, people should look at income, and I think people should look at security of income with a AAA rating. And from my perspective, I think those are 2 of the better names here in the stock market.
And Mark, final question. Is there anything that you are doing differently than Sir John would have done?
Yes, but I think that's part of his approach. I mean, his approach was to always do things differently.
Improvise.
So one of the main differences is that Sir John actually used to take big currency bets. Obviously, when you invest in stocks all over the world, you have a basket of currencies all over the world. He never hedged those currencies back to his dollar. But he would also take a strong view on a currency. I hedged a lot of currencies. I think currency risk today is very strong. I don't want to assume a lot of that risk.
And on that note, we will end this conversation. Mark Holowesko, thank you so much. It was such a treat to have you on Wealth Track.
Well, it's good to see you again.
Share Sir John's wisdom and also your own, which is considerable as well. So thanks for being here.
Thank you.
I know Sir John is looking down at Mark Holowesko, smiling and saying, keep up the good work. Well, at the conclusion of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point picks up on one of Mark and Sir John's major themes: keep an open mind. The market is constantly changing. No one approach works all the time. Sir John and Mark Holowesko are always looking at what the market is offering you. As Mark commented, Sir John's genius was the simplicity of his approach. always looking for what was cheapest in the markets. And on a personal note, Sir John was one of my heroes, not for his financial skills, which were phenomenal, but for his richness of spirit and endless capacity to learn and love. A truly remarkable man. And that concludes this edition of Wealth Track. Next week is a National Pledge Week on public television. So many stations will not carry Wealth Track during their fund drives, but some will, including our presenting station, WLIW in New York. We will revisit a fascinating discussion with financial thought leader Michael Mauboussin, Chief Investment Strategist of Legg Mason Capital Management, who will explain why doing less in the markets can actually make you more. And for those of you who want to see our Wealth Track interviews ahead of the pack, including this week's exclusive interview with great investor Mark Holowesko, subscribers can see our program 48 hours in advance, as well as timely interviews exclusive to Wealth Track web subscribers. To sign up, go to our website, wealthtrack.com. Thank you for watching, and make the week ahead a profitable and a productive one.
Now, more than ever, you want to keep your loved ones safe and secure. We've been helping protect families with the gift of financial security for over 164 years. New York Life, the company you keep.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.